everyone, and welcome to the very first episode of FDIalogue, your go-to podcast for insights on foreign direct investment and its impacts on various industries in Indonesia and across the globe. This podcast is brought to you by Global Indonesia Professionals Association, or GIPA. GIPA is a global secretariat of Indonesian professionals and executives across G20 and ASEAN, which represents 8 key industries around the world. And we help advance Indonesia's economic diplomacy as well as human capital development. I'm Shalka. I am an economic diplomacy associate at GIPA. I am also an Indonesian professional working in economic research industry. And joining with me is my friend Crystal. And together we are the hosts for today's episode.
Hi everyone, I'm Crystal and I'm also from GIPA's Economic Diplomacy team, and we aim to promote business and investment links through highly talented Indonesian professionals and execs overseas. I'm an implementation specialist from a tech company and I'm based in Indonesia.
Yes, thank you, Crystal. Today we are taking a deep dive into how foreign direct investments can thrive in Indonesia's textile sector, which is the theme for our first episode of FDIalogue. And this conversation is inspired by a fascinating paper by Olga Karnas, who is with us today as a wonderful and very special guest star. So big thanks to her for laying the groundwork for our discussion today. And we'll be exploring why Indonesia's textile industry is at a crossroads, how global capital inflows can ultimately influence the trajectory, and what policymakers, businesses, and professionals can do to navigate these opportunities and challenges. Hi, Olga. Welcome to our first episode of FDIalogue. How are you today?
Very well, thank you. I'm super excited to be here with you, Shalka and Crystal. Thanks for having me.
Would you like to start by telling us a little bit about yourself?
So I'm a second-year Master's of Business Administration student at the Harvard Business School. For the past year, I've been doing research on Indonesia and FDI in Indonesia, and the idea is for that research to be published in the form of a case study, which is the teaching method at Harvard Business School. Every class is a discussion between a professor and the students based on a case study that someone had written based on research on the ground. So to that end, I've interviewed over 20 people from the Indonesia business community and looked through a lot of data on the FDI patterns in Indonesia to see what is the challenge and the opportunity for Indonesia's economy today.
Yeah, that's wonderful. To be honest, I am very fascinated by the fact that you're super interested about Indonesia and our economic contacts and so on and so forth. And since, the theme of our podcast today is foreign direct investments, right? And you talk about that a lot in your paper. Would you please let us know, what is foreign direct investment and why do you think understanding FDI is an important aspect for everyone, especially for Indonesian professionals overseas?
I think the most important thing to remember about investing in a country is that there are two primary ways you can do it. One is foreign direct investment, which means you're putting something on the ground, a factory, or any sort of physical asset that people work in and create value with capital that's brought in from abroad. You're investing directly. And second one is sort of portfolio investments, hot money flows. You're investing in the stock market or in some sort of venture, but it's a much more touch and go investment versus FDI. FDI is much more long-term, you could say stable, but it also requires much more due diligence because you get locked into that investment. So it takes more capital, it takes more commitment, it takes more knowledge, but this is the kind of investment that has the most bearing on a country's development. And the main reason why is that a lot of developing countries just do not have enough savings internal to the country for capital formation that spurheads further development. So you need, for a period of your economic history, most countries do need capital from abroad to increase their to increase the bulk of capital in the economy, to make the economy more productive, and then sort of keep on going on its own accord. And FDI is not just limited to developing countries. Most FDI flows actually in the world flow into the United States for a variety of reasons. As well as other highly developed nations, but it's probably the best way of bringing development that we have had known since sort of mid 20th into 21st century, and my belief is that it's what it will continue to be.
In the paper that inspired this talk today, which you wrote under the title of Indonesia, Why Has FDI been limited and what does the textile industry reveal about the Indonesian economy? It's a very specific topic, and we just wanted to know, what is the inspiration behind your research specifically on textile industries, especially in the Indonesian context? So would you share with us about that?
Right. So I'll start a little bit from the beginning, how I got into this personally. Back when I was an undergraduate, which is almost a decade ago at Yale University, I was studying economics and anthropology, which I think are very complementary fields. And I was writing my thesis in anthropology about something else, very data-driven. And I was writing my economics thesis about the 20th century scholarship of anthropology in Bali, about Clifford Geertz and Margaret Mead coming to Bali in the context of 1965. It was a roughly theoretical paper, but because I got to travel a little bit to Indonesia, it did spur my interest with the improbable nation, as Indonesia is sometimes dubbed. And I graduated from college, went into sort of the corporate world, still got to travel a couple of times to Indonesia, and that didn't subside. And then when I went to business school, every once in a while we would do a case about Indonesia. But here's the thing, 2 out of 3 times a case on Indonesia at the business school would be about the Asian financial crisis, which is now 28 years ago. It's still an important story. It's a fascinating story, but with a median Indonesian around 31 years old of age, half of Indonesia's population does not remember the Asian financial crisis. So there is much more to the story of modern Indonesia than the AFC of 97, 98. And I think that's something that's missing from the sort of modern understanding of Indonesia abroad, is that people don't know just how big it is. People don't know that 1 in every 30 people in the world are Indonesian, and people don't know exactly what sort of potential it holds. People know about China and vaguely about Southeast Asia, but they don't have a good idea of just how much Indonesia can contribute to the world and how it can grow and develop in the next years. And then a sort of second thing I will also say about that is why FDI specifically is because there was a puzzle at the heart of the question that I started with a couple months ago, which was Indonesia has had, since the Asian financial crisis, a very even GDP growth, pretty much every year hitting 5%, not including COVID, but no one did. Very stable technocratic government, but with a very vibrant democracy. Indonesia is the world's most successful Islamic democracy. So you would think with very strong fundamentals like these, there would be a ton of investors going into Indonesia, knocking on the door. But it wasn't quite the case, even now, as sort of a lot of companies adopt the China plus one policy and want to diversify away from China for a host of geopolitical reasons. And I was wondering, why is that the case? Why had Indonesia been traditionally so self-contained? And there had been a lot of reasons for that, economic and political, that I've got to learn about. And that brings me to the third piece. So I told you why Indonesia, why FDI, and now why textiles, right? So sort of funneling this down, textiles for most developing countries, especially sort of the Asian tigers, Japan, Korea, China, in the 20th century, they're sort of a litmus test of industrialization. They're almost the easiest thing you can do once you start industrializing. So they start this flywheel effect of going higher up the value chain. The classic model in economics is called the flying geese, where you sort of start with textiles, then you go into sort of small electronics, then you go up the value chain, and you sort of reach up and up into semiconductors and chips. But that had been the traditional model of the 20th century, and a big question at the heart of my research too is that model still viable, and is it viable for every country? Is it viable for Indonesia? And because Indonesian textile industry, at the same time I was doing my research, was going through quite a rough patch with a lot of issues coming from the sort of automation that's going on in China that made textiles very, very cheap, with tariffs, with other import measures that made that research area extremely, extremely interesting to me. And that's how the topic came about, and that's where I dug in with my research.
Yeah, totally. I think it's quite interesting that you pay so much attention on problems that are existing, because as you said previously, our inflation remains stable over the past decade. Our GDP growth has been stable as well. But in terms of the FDI, as you said, we are lagging compared to peer countries, even in ASEAN, perhaps, like the ones that you mentioned in your paper as well. In your opinion, or maybe your research, or the times that you interviewed a lot of these Indonesian professionals, what do you think are the primary factors that limit FDI structurally in Indonesia compared to our ASEAN neighbors?
So I think the biggest structural piece that's always in the background when you look at Indonesia is the resource curse. And Indonesia has been endowed with a wealth of natural resources, which is not a bad thing. It just makes the dynamic very different than for many other countries. So when you think about the first ever FDI going into Indonesia in the 20th century, you think about Freeport, you think about oil and gold and coal and all those natural resources that are very cyclical. So they go through booms and they go through busts. And what that does to Indonesia, unfortunately, is that at times it appreciates the currency, which makes Indonesian exports less competitive in the global market. And then at the times of depression, it can really wreck the economy at times. So it makes the economy quite cyclical. However, obviously, resources in and of themselves are not a bad thing, and are something that Indonesia has been endowed with. Now, another aspect of the research course that people don't look at as much as they look at the currency and competitiveness of exports is that the resource industries don't actually employ a ton of people. So you don't need a lot of people getting the oil out of the ground, etc. Whereas as a nation industrializes, that usually comes up with a lot of people going to work into the factories, a lot of sort of absorbency of labor, and that makes the economy more sophisticated. That creates a lot of sectors, that creates agglomeration economy. So there's a lot of spillover effects from industrialization, where you need to put people in school and you need to feed people and you create cities and urbanization, and out of that a middle class emerges. And in any developing country's trajectory, whether you look at Britain or the UK or any developing country in the world, the most important factor is there going to be a middle class that is going to produce and consume and bring that country about. There is really no other way to go about growth. And I think the interesting story about Indonesia that I looked at, sort of looking back into Indonesia's economic past, is times where resources were doing really well and maybe the industry and manufacturing wasn't. And then, for instance, in the 80s, that reverses. The commodities are not trading well. So manufacturing really grew in the 80s really well in Indonesia. And then again, there was a bit of a reversal. And then came the Asian financial crisis, which was a big structural change to the economy, especially in its aftermath.
Now, talking about foreign direct investment, Indonesia has been expanding our share of FDI around critical mineral processing and manufacturing. You mentioned in your paper how the Dutch disease affected Indonesia to concentrate its economic driver on natural resources. So, from your perspective, how do you see the impact of Dutch disease influencing Indonesia's manufacturing sector, especially in the textile landscape? Does it make the textile manufacturing less competitive?
Yes and no. I think at times where I think it used to be more of a problem before than it is now. And that is a good thing. So I think in sort of the 90s and early 2000s in the textile industry, when countries were competing on who's going to produce more, they were competing on labor costs. And that's when Indonesia was losing because the currency would appreciate as the commodities appreciated. So Indonesia couldn't quite compete on cheap labor because of the economic fundamentals. And at the time that maybe made for a slower development, but honestly not really, because we know there had been a lot of textile champions in Indonesia. For instance, and you can see in my paper, a lot of Nike's production did happen and still does happen in Indonesia through a lot of intermediaries, through a lot of sort of original manufacturers that brought capital from Korea, Taiwan, Hong Kong. I sort of went into Bloomberg terminals to extract that data and map onto where the capital came from, and then the final sort of seller of those goods that are produced by Taiwanese and Korean companies in Indonesia is, for instance, Nike or Under Armour or Lululemon, all those companies. But I think now the tables have sort of turned because there is so much automation it came about in textile manufacturing that it's no longer a race to the bottom of who can produce more and cheaper. It is a game or who's more productive and who has the kind of labor that's educated to the point where they can work with that automation the most effectively. And I think that's where that disease becomes less relevant today than it was even 10 years ago. And again, that's an incredible opportunity for Indonesia because Indonesia is still the biggest country of ASEAN. It's still a very young country. And while people may look at Indonesia and say, well, there is 5,000 kilometers between, Aceh and Papua, at the end of the day, 60% of Indonesia lives in Java. And when you look at the textile industry, well, a lot of it is in Bandung and Bekasi, and there is quite a lot of agglomeration economies that can come from just how that industry is concentrated. So I know it's gone through a rough patch, and I write about a lot in my paper how the government has to step in, and roughly the data may not be complete, but it looks like in 2024 80,000 people had been laid off in the textile industry. At the same time, I would not short Indonesian textile industry quite yet. I think it does have fundamentally it holds quite a lot of promise just because of how it's been set up.
I could agree on you because Indonesia is the 14th largest exporter of textile and apparel, with the key markets in the US, Middle East, and Europe. But yet, our textile industry have been facing a decline over the past few years, with more companies struggling, factory closures, layoffs have increased since 2019, with utilization rate drops below 15%. So what do you think are the key factors behind this downturn? How effective do you think the current government policies, such as import tariffs, are in addressing these challenges?
So I think the story became very complicated in the last sort of 5 years, as you said, with the utilization dropping. And there had been a couple of things that loom very large over my research. One is, of course, China. The growth in robot density per worker in China has been astronomical. The only country right now that has higher density of robots is Korea. China overtook Germany, which used to be the number 2. And because of China's size, that obviously makes global textile markets very different now than they had been before. So that's a big part of it. Second issue that Indonesia is going up against, and that's something that is it's almost like the government's between a rock and a hard place. Because on one hand, you do not want the Chinese textile exports to flood your own domestic market or compete with you internationally. But on the other hand, Indonesia is a part of ASEAN. So what happens, unfortunately, is that a lot of imports of Chinese textiles or textile inputs, so cotton, raw cotton, and other things that then Indonesian factories make into final garments, come into Indonesia from China via Vietnam, because you can't restrict imports from Vietnam because of ASEAN. And Indonesia's government did try to to implement different measures that it could. For instance, tariffs at different points for Chinese textile goods reached up between 100 and 200% at times in the last 5 years, which is insane, but that's something you need to do. But on the other hand, government's hands are somewhat tied because of ASEAN, and that's a much bigger structural issue that you sort of do not want to play with. So in a way, I would say that part of the challenge is not necessarily competing on who can restrict China more, but who can attract more production and sort of go up the value chain. And the higher up the value chain you can compete, the usually the better for a country. And that, I think you've heard me say the word the country name Vietnam a number of times. Vietnam in the last couple of years had been incredibly successful in attracting foreign FDI as countries diversified from China, and there had been a lot of reasons for that. But to just give you some data, in 2023, FDI inflows to Indonesia were 23 billion dollars, which is $80 per capita, whereas Vietnam got to $360 per capita. So the differential right now is, I would say this is the current inflow, and we don't know if that trajectory continues. But the big question right now is, who is Indonesia competing with, and where it should compete to be the most productive. If you personally ask me, I think a lot of riches are in niches, and there's a couple places where Indonesian textile industry really excels. A couple of niches, for instance, Islamic halal clothing. That's a niche that Indonesia really excels at, and that may become a much bigger export market than it had been. So I would look at that. And another place where I would look at where Indonesia also puts a lot of sort of thinking and planning is into green textiles, eco textiles. And that is, I would say, you talked about nickel, and when we think about nickel, we don't necessarily think about textiles. There are very different things. But Indonesia does have a concerted governmental push towards the green transition. And we usually think nickel downstreaming, and EVs, but that's not that is actually quite contiguous with producing green textiles.
Also agree on that. You mentioned in your paper about how protectionist policies, including tariffs and local content requirements, does limit competitiveness for textile sector in Indonesia. But beyond dependence on government incentives, what can Indonesia's private sector do to make itself more appealing to the global professional and investors? Like, is there any strategy or maybe technology that we could have the private sector to leverage to build this more robust environment for the FDI in Indonesia's textile manufacturing?
I think it does require a lot of coordination with the authorities for a couple of reasons that you mentioned. So one is LARTA, so restrictions, the other is tariffs. And one more that I would mention that's very important are labor costs. So there is a couple of areas in which business really needs to work very closely with government to make sure that the environment is conducive to FDI. And what I mean by that is, it's not necessarily just that Indonesia may seem as a high cost. It's just that a lot of regulations do frequently change. So it's challenging to navigate for domestic producers, and it acts as a deterrent to foreign investors. The most successful FDI examples, the way they usually happen is either if a government brings an investor and sort of gives tax breaks or establishes special economic zones or provides a couple of incentives, or if it's a joint venture between a local partner and a foreign investor. But I think you always need to have that governmental player. Now, here's an interesting fact. Because OECD is putting in new rules around tax breaks, and the amount of tax breaks you can give to foreign investor is falling globally. The idea is to sort of reduce the tax havens around the world. Um, that that sort of that aspect falls away. And you can think if it's you can think that that's a negative because you can't compete on sort of bringing this big foreign investor and then just letting them go tax-free for 5 years or 10 years. If the rules are the same for everyone, for Vietnam and Indonesia and Thailand, Malaysia, and countries in the region and beyond, again, that's not a bad thing, because then what you compete on is not low costs, but again, quality of your labor, consistency of your governance, stability of your country. And those are things that Indonesia can do really well.
I see. Yes, that's a lot of different layers of, I think, um, potential challenges, but also perhaps opportunities moving forward, as we look at the development of policies that can support local industries such as textiles, or perhaps, these policies such as you said, some of the more structural ones like import restrictions or even non-tariff measurements and measures and so on and so forth. We've touched on different dimensions of FDI and its potential challenges, especially in textiles. But I think when it comes to talking about these challenges, it's always going to be political in a way that it would be influenced by the current priorities of Indonesian government. So let's move our angle a little bit to the policies that are existing right now and perhaps in the near future, in 5 to 10 years, as we're speaking. As we know that Indonesia currently has a very ambitious target of the 8% GDP growth, and the new president, Prabowo's administration, has also signaled, as you also said in your paper, a potential shift of the debt to GDP ratio and targets, as well as potential new economic policies. And with also, trade wars that are coming up and so on and so forth, which may open the door, for new opportunities and or even present fresh challenges for investors that are looking at Indonesia. And a lot of our overseas professionals watching as well, they're also, keeping a close eye on policy development in Indonesia, and they're, looking at the opportunities of contributing to Indonesia, specifically in the industry that we're talking about today. So, with the change of this leadership and policies, what do you think are your predictions for Indonesia's FDI trajectory in the next 5 to 10 years? Or do you think it's a positive trend, or, what are the enablers that we should have in order for that to be achieved?
So I would start with what you said about the debt to GDP ratio, which the current administration is looking to increase from 40 to 50%. So that's a massive increase, right? That's a quarter. And sometimes a lot of foreign investors or foreign commentators come at that with, a lot of caution. Oh my God, this is not fiscally prudent. This is plunging a country into debt. But I think debt is an instrument, and if used well, it can give that needed sort of spark or engine to Indonesia's growth. And what I mean by that is government investment in things like infrastructure, education, vocational education can be something that brings in more investors than not. Because at the end, the key to development is sort of breaking out of a cycle of, underdevelopment and debt and more problems into this virtual self-sustaining cycle once you have a certain basis for growth, where you have a certain level of infrastructure, a level of business friendliness, then businesses come and then keep coming. Unfortunately, what we see in the markets, it's a little more pronounced in sort of portfolio investments, but a little bit in FDI as well as herd behavior. You just need some people to come for more of them to come, people and businesses, and most importantly, capital. So I wouldn't worry about the debt itself in a country that, as Indonesia had been, is again robust democracy, very technocratic, very well educated executive branch of the government. It's something that a lot of investors overlook, and they shouldn't. And historically, given how cautious Indonesia had been since the Asian financial crisis, how strong the banking sector is, I would honestly look. I personally have a very positive outlook on what that increase in debt could potentially do to the country, if used well. But at the same time, nothing ever happens in a vacuum. So the global context is going to be key. And what I mean by that, we've seen a lot of, every time, most importantly, the US raises rates, there is a big outflow of investment from developing countries, including Indonesia. We've seen that quite recently, 10 years ago in Indonesia, during the taper tantrum, where investments very quickly went out, and that created a little bit of instability, but the government tackled that very well at the time. So I think the government is doing what it can do in these circumstances, and the question is the world macroeconomic situation be a tailwind or a headwind? And of course, wishing for a tailwind there. So to what you said, so maybe that this is not necessarily specific to the textile industry, but if you look at nickel downstreaming, EV boom, if that transition accelerates beyond domestic demand in China into more demand in developing nations, that could be a huge tailwind for Indonesia. And again, if the more debt is channeled into good infrastructure or other measures that bring in more businesses, that could be something that propels Indonesia further. Because when a lot of commentators say that the 8% growth that the President Prabowo's administration had been talking about quite a lot in the recent months, they say, oh, it's too high, it's unrealistic, it requires more debt. I agree with that, but on the other hand, in order to develop and do that in a sustainable fashion, you do need to hit those 7%, 8% for a couple of years consistently. So if people think that's an unrealistic goal, I would counter that with, numbers wise, there is no other way. So it's not a question of whether 8% or 7% is realistic. Is how best to get there and what tools to leverage. And if increasing national debt is one such tools, then hopefully it works out. But other than being smart about it, you also need to be lucky about it. And by lucky, I mean you need. By lucky, I mean if, for instance, if interest rates in the US have started going down. Will they go down back to the almost zero levels that we've seen in the past decades? Maybe not, but will they go down substantially enough for more investors to consider maybe going to venturing out closer to the equator? Hopefully, yes.
Well, talking about a supporting tool to support our 8% GDP growth target, our textile industries does employs around 3 million workers. It's about 18% of the manufacturing jobs, and they actually contributed around $12 billion annually in exports. But yet countries like India, Vietnam, and China are the ones that successfully position themselves as global manufacturing hubs. In this global shift towards more sustainable and technologically advanced manufacturing, we kind of need to shift to avoid the reliance on those cheap labors, as you mentioned. So Olga, I want to know What do you think have been or will be the key qualities or opportunities that really attract foreign investors to Indonesia's textile ecosystem? And are there any common misconceptions they might have about the country?
I'll start with the common misconceptions. I think that's a very important question. Um, Sometimes when there's a discussion about a sort of middle income country like Indonesia, a lot of people talk about, oh my God, there's so much corruption. And the discussion starts and ends there. And that becomes an extremely reductionist view that people hold because have I got news for you? There is corruption everywhere, US included, right? And it's very hard to measure corruption, and it's very hard to measure at the end of the day the business friendliness. Um, and a lot of people seem to be deterred by that, but at the end of the day, something that I've kept hearing from both business people who are Indonesians working in Indonesia, as well as expats who have spent sometimes 2, 3 decades in Indonesia, is that there had been a cultural shift away from corruption. It doesn't mean it doesn't exist. It just means the culture around it had changed. And again, that's not something I can substantiate with any data because it's very hard to measure corruption. Unless something like one IMDb happens in Malaysia, and they still don't know how much, how much money was lost in that. So a common misconception is around that. When you actually go a layer deeper into what brings people to invest in developing markets or what deters them from it, you end up looking at a mosaic of factors that are always interplaying with each other. And one piece, as we said, is around sort of the inputs. If you have the raw materials, how hard it is to get the raw materials. The other one is about non-tariff measures. The other part is about government regulations and taxes. And then something that Indonesia has really worked on in the last couple of years is the elasticity of the labor market. So a lot of my paper talks about the omnibus law and the regulations that came out of that, and they're still coming out of that, which talk about the impact of regional minimum wages on industrialization in Indonesia, of the kind of structurally more expensive labor market that could have hindered FDI in years prior. Now, the thing about successful FDI is that there is no secret formula. Everyone knows what needs to be done for a country to attract and sustain high levels of FDI and go on to industrialization. It's for there to be a lot of transparency, for there to be good contract enforcement. That's extremely important. For there to be the supply of labor, for there to be, for instance, incentives for universities to do R&D with the companies, for there to be intellectual property protections and enforcement. So in a way, you can list all the elements for successful FDI attraction, and in any country and in most contexts, those elements will be 80% the same. The most difficult part is the coordination. So we talked about the coordination between domestic business, the government, the local government, and the foreign business, and also labor, for instance, labor unions, right? So the recipe is not unknown. It's just the level of coordination that is required is what makes it difficult. And sometimes it becomes easier on the surface to do in a more authoritarian system or in a more centralized system. And that's why China had been very successful, or Vietnam had been very successful more recently, is because that coordination between labor, domestic firms, and the government appears easier to do. But the trick about FDI is you go in for the long haul. And if you go into a country as an investor where you have skin in the game and you put a factory on the ground. And once you do it, once you've done this big investment, you're very dependent on a government that may be to an extent authoritarian or has an upper hand on you, and where the rules maybe are clear, but they can change really fast on you. That puts you in what is called an obsolescing bargain, where you have an upper hand once you go in, but once you're in, you're locked in, and that's when you sort of your cards become much worse than they were on the onset. And I think this is where Indonesia's strength really shines. At the end of the day, you can tell that from not only how politics is done in Indonesia, but also how much stronger the civil society is in Indonesia than in any other country in the region, how there are the labor unions, how politics happens, how much freer the press is, that even though you can still argue there is corruption, it's really hard not to have it. And I argue there isn't a country free of that. Even though you can see the regulations are changing a lot, and the omnibus law had not been fully incorporated, and and the omnibus law had been politically quite contentious, but politics happen in Indonesia. So as an investor, you may seem more hesitant to go in. It doesn't seem as easy to go in, but once you're in, it may not be it's not exactly like in a more authoritarian system that you're completely at the mercy of the local government or the central government. Because politics still happens, you can sort of find your way in the system. And what I mean by that is you can demonstrate your value, provide your value, and not worry that someone's gonna knock on your door and appropriate your asset, like it could happen in an undemocratic system. And that's something that investors fear. Investors fear that democracies are messy. Democracies are inherently messy, but that also makes them more resilient. And I would argue it's better for FDI to be channeled into democracies, not for purely political or ideological reasons. It's not, that democracies all glitter unicorns and great system, and let's be idealistic about it. But think about from a perspective of an investor, whether you would rather go in and things are easy at the get-go, but then you don't quite know where you stand, versus a system where there are checks and balances and politics still happens, which means you're not at the mercy of a couple of personal decisions.
Awesome. Totally agree with all of your points. And thank you so much for mentioning that coordination and implementation is a far more, challenging aspect to all of the important elements that make an FDI successful, that perhaps, sometimes we like to blame the policies or blame like the environment, the ecosystem, but in truth, like the hardest part of it, no matter how beautifully crafted all these policies are, if the implementation on the ground is not as coordinated as you said, then it's not going to be optimal as well. So thanks so much for mentioning that, and hopefully that opens the eyes of everyone who's watching, whether it be Indonesian professionals, policymakers, industry stakeholders, and hopefully that gives us a fresh idea that we should focus on building FDI not only from the policy perspective, but also from the ground up. So we're coming to a close actually, but before we end, Olga, it's been a very interesting discussion. We just wanted to know, what message would you share with policymakers, industry stakeholders, and perhaps global investors, and also our Indonesian professionals working overseas, to unlock this FDI potential that can be achieved by Indonesia?
Okay, I'll start with not getting held up by path dependency. So for a number of reasons, some of which we've discussed, Indonesia had been quite insular in the sense that it hadn't attracted that much foreign investment beyond natural resources for a number of years. And, there had been booms and busts and different circumstances. But I think I think it's easy to get bogged down and say, I've always been going to China, or maybe Vietnam's going to give me a special economic zone and a tax break. But I think it's important to adopt a fresh new perspective and look at how Indonesia can change. And also, I do hold a strong belief that Indonesia, being still a very young and a big nation, that there is a certain quality to the size of the internal market alone. So with the number of consumers you could reach in Indonesia, any idea can spread much faster, or any product can attract a much wider market than anywhere else in the region. And there are really few countries right now that hold a similar promise. And I think that to the investors, I would definitely examine that. I think, given that there isn't a ton of FDI, it may be scary for first movers, but investors tend to exhibit a lot of that herd behavior. So you need to, as an investor, you need to decide if you want to be sort of the first or later down the line, and what that's going to give you. And of course, there are always diversification strategies. So this calculus is going to look very different for different industries and for different levels of capital. When it comes to, Indonesia in and of itself, I will go back to my point about coordination. I think that the elements are there. The key is that, they constantly interplay, and having them and aligning something as complicated is always going to be messy. And, you take one step forward and two steps back, and that's unfortunately the reality. It's easy to write a strategy, much harder to implement it, and people tend to argue about whether someone's strategy is better or worse, whether it's a government or a company. But at the end of the day, it's about how your plans react to reality, and how well you can actually implement them. And sometimes, when governments change, we hold a very high bar, and we expect things to just now change and do it fast, and we don't have much tolerance or patience for how much time and coordination it takes for something to change, and especially in a country as diverse and as complex as Indonesia. So on a part of Indonesians and investors, there is that patience bit that is hard. It's just hard. One of my interviewees evoked the phrase that was the sort of the beacon of Indonesia's foreign policy, bebas active, independent and active. And she said, she was an amazing businesswoman, and she said, this is how Indonesia has done its foreign policy, but that's also how we think about our businesses as Indonesian entrepreneurs. We need to be independent, think independently, and be active, and not get bogged down by certain difficult realities on the ground, which, for instance, this year there had been a notable decrease in Indonesia's middle class, and that's a challenge. And there are global headwinds coming, and trade wars, and that's again a challenge. But you need to stay bebas and active, and that's, I think, that attitude in and of itself is a big strength of democracy writ large, and of Indonesia specifically. And lastly, for GIPA, for all the emigre Indonesians, first of all, everyone has a personal calculus. I'm an immigrant myself. I have a personal calculus, how I want to, live and contribute, and where I want to go, and what I want to do. So I think it's, at the end of the day, everyone needs to shape their fate individually. But one thing is, I might be biased. I had obviously not grown up in Indonesia, and my bahasa is very, very, very rudimentary. But I'm very excited about what Indonesia can be because of the last 20 or so years when it's shown incredible levels of resilience. And now with this sort of economic dividend, with just how many young people there are in Indonesia, and and median Indonesian is 31 years old and median Chinese is over 40. The next decade or two is gonna really define what Indonesia can be. Because after that, unfortunately, most countries, including developing countries, will get old. So it's sort of it's a bit of a cliche of, will this or that country be rich before it's old? And how rich can it become? But I do, and you can call that idealist, but I will be watching that very closely. In fact, I'm doing more research on foreign investment into Indonesia, because again, most of development cannot be financed from within and needs that money from abroad. And then the question is how you attract it and how you use it to get the engine going, to get the economy to where you want it to be. So I'll be watching it very closely. I'm doing more research on that very topic, sort of branching out into the different industries, so not just textiles this time. And I hope to spend more time in Indonesia in the next decade or so. So thanks so much for what GIPA is doing. I think this is a wonderful initiative and something that can really open up Indonesia to the world and give Indonesians a lot of insights.
Yes, awesome. Thank you so much, Olga. It's been super inspiring and even makes me feel even more hopeful about what the future holds for Indonesia. So, everyone, that wraps up our first episode of FDIalogue. How does FDI thrive for Indonesian textile industries? In this podcast episode, we explored a range of topics. We talked about regulatory uncertainties, the Dutch disease, to the potential of moving up the value chain in Indonesia's manufacturing sector, especially textiles, that we talked a lot about. So from my side, one key takeaway is that FDI is not just about the capital itself, but it's about fostering innovation, building strong workforce, and as well as creating a solid collaboration and coordination among policymakers and other stakeholders as well, like businesses, global investors. But it's important for us in Indonesia to ultimately find a balance between the capabilities and resources that we have, and also at the same time investing in sustainable as well as tech-driven manufacturing that can ultimately help us be more competitive on the global stage and also fuel the development in the long run. So yeah, that's from my side. What about you, Crystal?
Hey, thank you so much, Olga, for sharing with us. I love talking with you how Indonesia stands at a critical juncture as it transitions to a new presidency. While the textile industry illustrates broader challenges in FDIs and economic policy, the country has significant potential to become a diversified global economic powerhouse by reducing structural barriers, pursuing consistent and inclusive growth policy, just like what we talked about. Thanks so much, everyone.
And let us know your thoughts on our social media. Thank you, everyone. See you.
Thank you.